Welcome, everyone. Thank you for joining us here today. Today's webinar will be all about a new fund offering, that is NFO for Bandhan Multi-Asset Allocation Fund, by our expert presenter, Mr. Gaurab Parija. Mr. Gaurab Parija is the head of sales and marketing. He has over 25 years of experience in sales, marketing, business development, and driving strategic initiatives. Mr. Parija is responsible for driving accelerated business growth, working in seasoned sales and marketing teams across India, focusing on building strong partnerships and enhancing values to clients. He brings over 2 decades of mutual fund experience in retail sales and distribution and is among the most seasoned sales and marketing professionals in our industry. His deep relations and passion to add values to client make him stand out in the industry. He has associated with the fund house since March 2017. Prior to Bandhan Mutual Fund, he was associated with Franklin Templeton Services Private Limited as a director, responsible for new initiatives and business development, Senior India from March 2014 to March 2017. Prior to that, he was associated to Franklin Templeton Asset Management Private Limited as a national sales director for from April 2009 to April 2014. Head of retail advisory services from Jan 2008 to March 2009, and head of alternate distribution from June 2006 to December 2007. Mr. Parija holds a postgraduate diploma in business management from IIM Bangalore. Before we move forward, please note that if you have any questions related to today's topic, please put in the comment section below. So, over to you.
Thank you, Aditi, and thank you, SBI Caps, for giving us the opportunity. Firstly, a very happy new year to all those who are joining this webinar, and hopefully all of you had a good start to the new year 2024. Before I get into the presentation, it is also important that we are keeping ourselves safe and hearty. As we speak, there seems to be a new variant of COVID which seems to be springing up around the country. So hopefully we do take adequate care and precautions. Moving on to the main part of my presentation, which is going to cover the new fund of ours, which is Bandhan Multi-Asset Allocation Fund. We are very excited to launch this fund, and hopefully over the coming slides, I'll be able to explain as to why. So without wasting time, let me start as to the whole concept around this fund, beginning with what is asset allocation. Now, many of you on this call would have heard this term multiple times, from your relationship manager to reading about it in newspapers, seeing it on TV channels, that asset allocation is the key to creating wealth. Basically, asset allocation means, like if I had to give an analogy to a cricket team or a football team or even a meal we eat, typically every constituent of the meal has different elements to it. So in a normal dinner, we take some carbohydrates, we take proteins, we take fats to make it a well-rounded meal. Similarly, the team of football, you have someone who's a striker, someone who's a midfielder, defender, and a goalkeeper. And the reason these things have been done is that every person or every portion of the meal has a role to play. In a similar analogy, if you have to take it to our portfolios, we think it's imperative that we need to have multiple asset classes which have various different roles to play. For example, if I have to talk about the 4 asset classes we've shown, domestic equity or Indian equities, we all know over the last so many years, is the growth engine or the growth part of your portfolio. Fixed income, or traditionally we are used to fixed deposits or fixed income mutual funds, provide the stability to your fund. Over the years, as we've been investing in markets, we've realized that not only there is a need to invest in good Indian companies and good Indian mutual funds, but given that we are becoming far and far more insulated to what's happening in the world, there are enough and more strong stories and sectors outside of India, which also makes a lot of sense to your portfolio. And hence, international equities is coming through an asset class. And lastly, commodities, which is gold and silver. Now, do remember, when I talk about a asset allocation concept, for most Indians, a large component of the household savings is in real estate. So this is the 5th element of asset allocation. So what we are trying to focus on today is mostly on the movable asset allocation or the financial products. And clearly, asset allocation helps you get better risk-adjusted returns, reduce your volatility on the portfolio, and hence able to stick to your plan. Now, one of the mistakes a lot of people make when it comes to asset allocation is we try to impose the risk profile of oneself. So, if I'm talking about myself and having invested for 25, 30 years in the markets, I am more used to taking risk. I'm a risk, not a risk averse, but a risk taker. It doesn't mean that for every financial goal I should be able to take risk or I should take risk. For example, if I have to send my daughter to her higher education next year, and that's a year's goal, I'm not be obviously putting a lot of money in a risk asset which is domestic equity or international equity. And that's something fundamental we need to keep in mind before we talk about asset allocation. Now, given that you've heard this term many a time and many a, often, one of the things people ask us ki, you keep talking about it, but is there any scientific study or is there any study whatsoever which is done to prove that asset allocation actually works? And so we dug deep into our research, and what we found was that there was actually a study done way back in 1986 to 10,000 families in the US. And these families are people like you and me who have been working through their careers. We've not got a jackpot of money through selling a company, or we've not got a jackpot of money by unloading our ESOPs, but pretty much working people. And then the survey wanted to find out as to what was the reason they created so much wealth over their 25, 30 years. And once they got into the survey, the usual belief was that they thought the answer would be that, this investor managed to get a multi-bagger, or the investor through his relationship manager were able to time the markets and all of that. But what came through was absolutely fascinating. And what came through was that 92% of the time, the wealth created by an individual or the family was attributed to asset allocation. And this is 92%. It's not 50 or not 60, where you could say that no, asset allocation works 50-50. This is overwhelming proof that the single source of creating wealth in the long run is to get your asset allocation right. And what this also shows that all the noise and all the talk we have on कौन सा market, कौन सा stock में जाएंगे, कौन सा sector अभी खरीदेंगे, बाद में खरीदेंगे, elections आ रहा है, recession आ रहा है, contributes to only less than 6% of return. So if you get your asset allocation right, and at the cost of being boring or sounding cliche, this is what eventually in the long run will help you create wealth. And we can't re-emphasize that. And so why is that happening? Why is such a large component of wealth creation being attributed to asset allocation? And this is happening because of this slide, or with the table which I would commonly refer to as the periodic table of returns, because when I was a student of science, the periodic table was illustrated in this manner. And so what we've done is taken data for the last 12 years. And actually, if you have to pull it back to 1978 when the index started, in the US, they have data for this for 100 years because there are data points on multiple asset classes. What you find is very interesting. So if these are the four asset classes, G as in gold, I as in international equity, FI as in fixed income, and D is in domestic equity, what you see is a very interesting dance of colors. So the domestic equity was underperforming 24% in 2011. That time, most people hand to heart would be very panicky or very scared to invest in domestic equity and would have avoided the asset class. And lo behold, next year it was the best performing asset class. If you were to talk about recent times, if I was doing this call 1 year back, or if you were listening to TV channels 1 year back, the common narrative which used to come through was that US would go into a recession. There is such a rise in interest rates that US growth will slow down and what not, and hence get out of US markets. And look what has happened. 2023, actually, the whole market behaved in a very, very different manner than what was predicted. And US markets, in fact, international equity gave one of the best returns in the last year. So what this table basically is proving that for any investor or any market expert to predict what's going to happen is a luck by chance or a game of darts. And if that's the reason, why do we want to complicate our lives in trying to time the market and do security selection? And this is why the asset allocation model works brilliantly. The other reason why we, like I shared in my first opening statement, of why we choose in a thali to have different nutrients, like proteins and carbohydrate, is to give it a balance. Similarly, the way to do asset allocation is to choose securities which are not correlated to each other, which effectively means if you buy equity as an asset class, you should look at a product or an asset class which is complementary in nature. In that, if equities don't do well, this asset class will hold its value. So your overall portfolio doesn't drop very significantly when one asset class does poorly. And that is demonstrated by what we call correlation between asset classes. And this is beautifully illustrated here that if you are to take Nifty 50 and look at how Nifty is correlated to gold, what this demonstrates is that typical movements of the equity markets in India is completely reverse or different from how what the movement in gold prices are. So the way to read it is if equity prices go up by 1 rupee, gold actually over long periods of time, and last year could be aberration where both asset classes did well. But if you stretch it over long periods of time, it's found that when equity does well, that means when the economy is doing well, when there is risk on measure, people are all gung-ho about the growth prospects. Gold, which is typically your hedge for inflation, hedge for bad times, tends to do poorly. Even fascinating is the relation correlation between Indian equity and global equity. And this is why we think spreading your investments across 4 5 asset classes makes it gives it a very, very well-rounded portfolio from a risk-adjusted basis. I think one of the things most of us talk and we always talk is people only look at one aspect of the investment, which is return, but they completely forget what is the risk they're taking to get that return. And that is where in many a time what we see is that an investor gets into an equity strategy or a risky strategy. When the going is good, life is all hunky-dory. But if going gets bad, they turn very, very negative on the overall asset class for perpetuity. And that's been the experience typically in equity markets in the way we see investor behavior. The second thing, mistake which a lot of investors do, and obviously behavior is changing over a period of time, is that we tend to chase the best performing asset and invest more, and this best performing is over last period of time. So this is what we call rear view mirror style of investing. So you pretty much look at which asset class, which stock, which sector has done well previous year, and try to bet that in going years ahead this will also do well. So we also looked at that, and this is again very clearly demonstrated in one particular category, which is small caps. So what we've shown here, the red bar denotes the outperformance or underperformance of small caps over large caps, and the dark line demonstrates the amount of money coming into small caps. And as you will see, in April 19 to July 20, when small caps were underperforming, people started reducing exposure. When it again started doing well, people slowly increased. And when over the last 6 7 months, when outperformance has been very high, the amount of money which is flowing into small caps is far more than any other sector. This is what we call performance chasing strategy. So while many of you would argue that what is wrong in such strategy, who said that you should only follow one particular strategy, we wanted to again demonstrate that this strategy over the long run really doesn't work. So what we did was we went back 13 years and did two things. We created one portfolio which will overweight the allocation to better performing asset classes of the last year and underweight the allocation to poor performing asset classes. And the second style was we created a very simple portfolio which was equal weight across the four asset classes. And what we find again was very, very interesting is that if you were to chase performance, that is invest in last year's best performing asset class, over a 13-year period, your CAGR return would be 7.3. But if you kept it equal weighted, you actually beat it by 20%. So by being a dumb, boring, and a simple strategy, you actually outperform something which likes a very, very exciting, because you are keeping on churning and cutting the best performing to the worst performing and vice versa. So this again further reiterates the point that a simple asset allocation strategy can create huge amounts of wealth with very, very low volatility of long periods of time. And this is what we want to bring forth before I introduce you to the particular fund of mine, that portfolio performance attribution to a very large extent, and when I say very large, it's actually very large at 92, is attributed to asset allocation. This is happening because, like the periodic table of returns demonstrated, no asset class has actually consistently outperformed every other asset class over longer periods of time, because depending on economic and market cycles, asset classes tend to move up and down in terms of performance. And hence, it's absolutely critical to have a disciplined approach. Now, what asset allocation, equal weight strategy, or a simple strategy does is, we all know academically and theoretically that if you are starting with an asset allocation of 50-50 into asset class, and if 50 becomes 65, you should be cutting 15% and bringing it back to 50, or adding enough in the other asset class to make it back 50-50. But very easier said than done, because do remember that as human beings, two things drive our approach or view on investing in uh, financial products. One is fear and one is greed. So if I have to flashback to March 20 to May 20, all of us were so fearful about what's happening in the world that we pretty much wrote off both the index, the Nifty and the Sensex, and said, no, let's just clamp down and just put money in plain vanilla, boring fixed income products. Today, as we speak, and as I travel around, people think that the next 10 years is a one-way street in terms of equities, and there is nothing called counter-cyclical asset classes like fixed income. And this is where, over long periods of time, we've been found wanting and being found caught on the wrong side. So if that is the reason and that is the way forward, we thought we will create a strategy or a fund which will help you take exposure into this powerful concept called asset allocation. So what we put together to you is a very, very simple product, where the construct is that, basis the long term expectation of each asset class, we will give a certain weightage to the fund of that asset class. This allocation has been backed by research and proven that over backtesting, long periods of backtesting, this strategy seems to be the best fit. What we also are doing is, while the overall allocation to each asset class would be pretty much fixed, within the asset class, we will give the fund manager the freedom to take his or own decision in creating a portfolio. And that's the best of both worlds, that on top you have a broad based asset allocation, but within the sub asset, you leave it to the fund manager to take a call. So, what is the proportion and the weightage we want to follow? The weight and proportion we want to follow is that, at all given points of time, and when I say all given points of time, we would want to rebalance it pretty much every 6 months. Domestic equities will have a weightage of 50%. International equities will have a weightage of 15%. So the top line is the growth assets which we want to keep. And the reason why we kept domestic and international is what I explained earlier, that there are enough and more companies, not only in India, but outside of the world. The correlation between Indian equity markets and international markets are very different. And hence, it's good to have two different asset classes. And over a period of time, we've also found, and studies have demonstrated, that asset allocation is not only diversifying across asset classes, but also diversifying across multiple geographies. We are bringing in 15% in arbitrage to give it the equity taxation. Please remember, this equity taxation is as per current tax laws. We would sincerely urge you to consult your tax advisor before deciding on whether it meets the criteria of taxation for equity or not. If that changes with subsequent budgets, we'll have to revisit this allocation. We've kept 5% each in gold and silver, 5% in a gold ETF, 5% in a silver ETF, and 10% would be what we call the counter-cyclical portion of your portfolio, which will be in fixed income, but managed in high quality fixed income. Now, the very interesting part of the periodic table was that, while on a broad level you saw domestic equity, gold, and others moving up and down, if you have to take just domestic equity and further cut it on market cap segment, and you said, okay, let us try to understand how does a large cap, mid cap, and small cap do over periods of time. And what is even more exciting is that, like the asset classes, the sub market cap segments also go up and down. And I think if you were to jog your memories over the recent past, 2015 to 2018 was a great run for small caps. 2018 to 2020 saw the reversal where large caps did very well. Post COVID, when the whole world was feeling very gloomy and disappointed, small caps has had a massive bull run. And hence, we believe that in order to get our investors the best of all worlds, we will run the domestic equity in what we call a multi-cap strategy. A multi-cap strategy or multi-cap funds, as many of you will be aware, is a different category in itself by the uh, regulator, in which there is a requirement to have at least 25% in large caps, at least 25% in mid caps, and at least 25% in small caps. Now, given that this is a multi-asset allocation fund and is and while it is suited for all investors, this is clearly a suited for an investor who's wanting a moderate risk asset class. We've limited the amount of money which we can invest in mid caps to 35 and small caps to 30%. Now, the please remember this is 30% of the total 50%. In effect, at best, the Bandhan Multi-Asset Allocation Fund will have an allocation of 15% to small caps, and that's to give you the choice of all the three market cap segments within the domestic equity. In terms of fixed income, as a house, Bandhan Mutual Fund is known for its uh, uh, focus on quality assets, and in this fund there will be not no different. We will invest in high quality government bonds, SDLs, which are government guaranteed bonds, corporate bonds, and money market instruments, all AAA and above. So from your perspective, you can rest assured that we will not take credit calls. We will not go into lesser rated papers in the 10% component. Having said that, like I said, if the fund manager believes that he or she needs to take a call on duration, we would allow for that. From an overseas ETF, we will invest in a international ETF, which will give you the best of three worlds, which is US, developed and emerging. And from a gold and silver, sorry, there's a typo. It is investment through domestic gold and silver ETFs. And that's the residual 10% which will go into it. Why should you look at a Bandhan multi-asset allocation fund, given that there are a plethora of multi-asset allocation funds? I think the big differentiator, and we want to repeat and say it upfront and very loudly, is the fact that we think this is like running an open kitchen shop. So, as an investor at any given point of time, you need not be scratching your head in trying to understand what is the amount of equity this multi-asset fund will have, what is the amount of gold, and all of that. So, typically, if you were to compare various multi-asset allocation funds, most of them have a range saying that equity could be between 30 to 60, gold could be between 10 to 30, fixed income could be 10 to 40. What we've done, and like I've demonstrated in my earlier slide, we've tried to keep it very simple. The reason we've kept it very simple and static is, if over longer periods of time we have found that we really can't predict which asset classes will do well, by putting a complicated algo or a model on top is clearly defeating the whole purpose of asset allocation. And hence we've said we will keep it a static model, static in the sense that we would want to revisit it every 6 months and rebalance. And from an investor perspective, it gives you a very clear understanding of what is the investment approach. And hence we call it the open kitchen concept. And to that extent, what as an investor you get is, you buy one fund, you get 5 sub-asset classes, within which there are 13 sub-asset classes. So you get a large cap exposure in India, mid cap, small cap, US equity, developed markets, emerging, and the list goes on. So instead of having to jiggle around and juggle around with multiple asset classes, you just buy the Bandhan Multi-Asset Allocation Fund and you're sorted from a coverage of financial assets is concerned. As I said, we've actually backtested the data as to how does this fund compare to the performance of a Nifty or a gold and silver. And what you find is that over multiple years and frequencies, the fund does as well as the Nifty, but more importantly, it does it with half the volatility or submission. Now, many a time, this aspect of or this ratio is not looked at very seriously by investors, but this is the part which actually gives you a smoother experience or a bumpier ride. And what we find, and typically investors, that when, like I said, if the going is good, we overlook all the risk and all the choppiness, but when the going get bad, we tend to have very low belief in the underlying asset classes. So this strategy clearly smoothens the ride without compensating returns to a large extent. The reason we've not gone overweight on gold and silver is, please remember, commodities or gold and silver especially are inflation hedges, or are does well when the markets or the economy is not doing well. By itself, they don't generate returns. So if you have to look at the overall long term returns also. For a gold and silver, it's the best has been 8.8 on an annual basis, but over 3 and 5 years, it's all 5 to 6%. So hence we've done a lot of back study to say, okay, what is the optimal weightage to each asset class, which is best suited for a long term strategy and a multi-asset allocation fund. So to sum up, the key reason why we think you should consider a multi-asset allocation fund is research clearly is indicating that 92% of portfolio returns come from asset allocation. Asset allocation takes out one of the most important reasons why investors don't create wealth, which is human biases and human emotions. Because of a static asset allocation, we will tend to rebalance this as per a set frequency on a to the back to its static model, and in a way we would also cut our emotions and biases of our belief of how one asset class will do well by moving it back to its weightages. It leverages the power of 13 sub asset classes. And lastly, like I just demonstrated, the returns on a risk adjusted basis is extremely high and hence suitable for most financial goals, typically over 3 years and across the span of investors, irrespective whether you're starting off to invest or you're about to retire. So it is one product which pretty much is time agnostic, style agnostic, and age agnostic. And that's why we believe this is a great product to consider in adding to your portfolio. The NFO starts from today and ends by 24th. I'm sure your relationship managers in SBI Caps will reach out to you. With this, I will take a break and open up for any questions people would have.
Thank you, Gaurab sir, for wonderful presentation. We will now take time for a few question and answer round. So, we have the first question. Wow. Yes.
What's the interest rate apply on E margin? Sorry, I think Aditi, you might have to take that.
So, we have another question. How NFO is helpful?
I think I just went through a series of slides showing why this fund, the multi asset allocation, is a good fund for most investors who are getting into the markets. We clearly don't know which asset class will do well. Hence, a fund which offers a combination of asset classes across various weights, which is rebalanced on a methodical manner, helps an investor cut out biases not only at the investors level but also at the fund managers level.
Thank you, sir. We have a next question. What is the difference between NFO and IPO?
A good question. I think NFO has been the term which the mutual fund industry has adopted when we are launching a new fund. Earlier, when I joined the industry, this was also called an IPO. I think it got very confusing as to whether the IPO was of a mutual fund or a stock. So the terminology used for a new fund, for any new launch by a mutual fund, is classified now as a NFO. IPO is typically which is of a stock, an equity stock.
Thank you, sir. We have another question. So, so is it always good to invest in multi-asset?
So I'll be very honest. I don't think there is any strategy which is always good. It is, like I said, it is time agnostic. Uh, the only scenario where I won't say it is good is for someone who is very evolved, who understands stock markets at the back of the hand, has been investing in stocks for 25, 30, 35 years. Someone like me who's been in the markets for so long that I understand the risk attached with investing directly in stocks. But for majority of Indians who clearly are in different professions and not in the markets, I think it's a great strategy to buy over multitude of goals. But the only caveat is don't look to invest in a multi-asset fund if you have a very short-term goal of anything less than 3 years. But beyond that, across age groups, across time horizons, this is a great strategy to be investing in.
Right. We have a next question. What is the expense ratio as well direct plan?
On the regular plan, would it would be around 2 to 2.1 depending on how much money we collect. If it's a very super successful NFO because you've all agreed, been convinced by what I said, and you put a lot of money, then the size will become large and the expense ratio will come. But typically, looking at a ballpark figure of 1,500 crores, we think the expense on the regular would be 2.05%, and knock off another 140, 150 basis on distribution expense. So the regular would be, say, 50 to 60 basis.
We have next question. How NFO is better than SIP?
No, I think, Jadip, I think you're mixing two concepts. NFO is a new fund offer. That is when I bring a multi-asset fund or a small cap fund or a mid cap fund into a initiation. So I'm launching it for the first time and I offer units at 10 rupees. SIP is a way in which you can invest in the product. So either you can choose to put a lump sum that you have, let's say 5 lakhs, and you put 5 lakhs at one go. But for most investors who are salaried like me, may not have such a large amount of money except during the bonus month. You'd want to sign up for SIP or a systematic investment and saying, I like this fund, but I would want to commit, say, every month 10,000 rupees. So that's the difference. I don't think you should be confusing NFO with SIP.
Next question we have is there any lack in time and any exit load?
Yeah, like I showed, the exit load is 0.5% if it's redeemed within 30 days. So it's a very, very small exit load of zero point 0.5, and that too only for 30 days. And the other benefit we've given, that of your total investment you make, up to 10%, there is no exit load even if you walk out and do a STP or whatever.
We have a next question. What should be the ideal investment horizon for this fund?
Like I've been saying, anything over 3 years, I think makes this is a good fund to be investing in.
Uh, and is it the good time to invest now?
Oh, absolutely. I think it's a very good question. A lot of times when we launch a new fund, people criticize us saying, "Oh, you're being tactical or cheeky. That now is the right time to invest. So you're coming with a strategy." For a change, sir, this fund is coming at a time, is such a fund that there's nothing called time. You can invest at any time of the year, any time of the markets, because what it does, it rebalances into asset class depending on a very static model. It is not taking any tactical call that, oh, you know what, equities will do well, so I'll overweight it, underweight gold. And hence I think this is a rare fund where you are time agnostic. You can just buy any time.
Uh, we have next question. Multi-asset investment is good for how long investment period?
So I'll be again very straight up in this, that over 15, 20, 25 years, if you have such a long horizon, multi-asset will do well if you don't want to take a very aggressive or risk tolerance is moderate. But if you are comfortable with the volatilities of equity as an asset class, and if you are investing and have a very clear vision that you will stay invested for 15, 20 years, equity mutual funds will outperform multi-asset allocation funds. I don't want to beat around the bush just because I'm launching NFO, but be very clear that your investment in a equity mutual fund would be far more volatile than a multi-asset. So as an investor, if you want a smoother ride, choose the multi-asset. But you're okay with a roller coaster, but want effectively higher returns, then I would choose an equity open-ended fund.
We have next question. Is it
Mr. Sahu, yes,
open-ended fund?
yeah, yeah, it is an open-ended.
Any more questions? Uh, okay. It looks like we have covered all the bases. Is there anything else you wanted me to mention, sir, before wrapping up?
No, thank you for having us on the show, and thanks everyone for taking time off. We are very excited on this new fund offering. We think it's, like I said, it's a fund which is pretty much time agnostic, market cap agnostic, age agnostic, and goal agnostic. So, for a change, we've been able to launch a fund where you don't have to be a particular type of investor to invest in this fund.
Thank you, sir. Thank you, everyone. We appreciate you being here. Thanks for joining us today, and we will see you all next time around. Thank you.
Thanks once again for having me on the show. All the best. Bye.
Thank you, sir.